We'll be focusing on numericals mainly. Okay. So everyone, don't miss the classes. Okay. We'll be going very, very fast. We'll be going very, very fast. Okay. So don't miss it. Okay. Chalo, let's start. First, here I'll be sharing with you who all are new over here. How many of you are new over here? Newly joined. Those who have newly joined, kindly join the WhatsApp group. Okay? Kindly join the WhatsApp group. Okay, without fail. Join it ASAP. Okay? Hold on. Yeah. So take this. See, this is a WhatsApp group. Those who have newly joined, kindly join the WhatsApp group. Joined. Good evening. I'll mark this, pin this, yeah. Okay, good evening, Nagbhushan. Good evening, everyone. Chalo, let's start. I'll be sharing with you, number one, the complete BFM PDF. Complete BFM. Okay, in the group I'll be sharing, not over here. Complete BFM PDF. Okay, that PDF and the classes, enough. Don't read anything else. Okay, chalo, let's start. So, what are the factors affecting the exchange rates? Here, we are starting with module A, foreign exchange. So, what are the factors that affect the exchange rate? There are two types of factors. One is fundamental and second is technical. One is fundamental, second is technical. Long term, short term. Long term is fundamental, short term is technical. Let's see the fundamental first. Balance of payment. Now, balance of payment and balance of trade. There are two types of balances. You all might be knowing this, but then also repeat. Balance of trade and balance of payment. Two types of balances are there. Balance of trade consists of import and export. Name itself it suggests trade. Trade means trading, business. Good evening. Good evening, everyone. Trading means business. So balance of trade is related to business and balance of payment, remaining things. What are the remaining things? Remaining things means NRI transfers funds. Somebody is an NRI over there. He transfers funds to our country, Bharat. So, NRI transferring funds, no business. Okay, business is not there. FDI, foreign direct investment, that is also under balance of payment. Kindly note, that is not under balance of trade. Balance of trade comes whenever you have an exchange. Goods gone, money in. Money gone, goods in. So that is balance of trade. FDI, FPI, foreign portfolio investment, all that comes under balance of payment. Because there is no exchange in that. Okay. So balance of payment means what? Basically, this is the final thing for balance of payment. See, even balance of trade, the net amount means plus and minus the net amount of balance of trade will be ultimately transferred to balance of payment. Kindly note this, balance of trade, it's like the current account and saving account. So net of current account is always transferred to the owner's saving account. So net balance of payment is the final one. Okay. Second is economic growth. So we call it GDP. So a high GDP will lead to a stronger currency. Okay, will further in the long run it will lead to stronger GDP, a stronger currency. Fiscal policy. Fiscal policy means, see this, there are three policies. Kindly note. One is fiscal, second is exim, third is monetary. Fiscal policy, monetary policy, exim policy. Exim policy is not that much important now from our point of view, from our BFM point of view. Fiscal and monetary are very important. Fiscal policy is given by government, finance department. Finance department. Fiscal policy is given by government, finance department. Monetary policy is given by RBI. Okay. Fiscal policy deals in taxes and charges, fees. Monetary policy deals in CRR, SLR. Okay. CRR mainly and repo. Okay. So these are the four basic reasons. There are two more. Interest rates. Interest rates means what? Your repo rate. Generally, any country which has lower interest rate, generally I am saying lower interest rate, has stronger currency. Any country which has lower interest rate has stronger currency. Okay. So high domestic interest rate tend to attract overseas capital. So if here, look at our country. Our repo rate is around 6.25. Now it is, I think so, 6.6 it is now. Yeah. Present repo rate, they have reduced it just now. Okay. Six, correct? So repo rate is 6 now. Okay. So look at our repo rate and look at USA repo rate. USA repo rate is very less, around 3.54. That also now that it has increased. Earlier it was 0.5 USA repo rate. So if any country has lower repo rate or interest rate, it will always have a stronger currency. Okay. Political issues. Political means what? This Bangladesh. Nowadays you see all this. Bangladesh, Pakistan, right? So immediately there is change in regime. So there will be change in the currency also. The currency has fallen for these countries, isn't it? This is called as pestle. Pestle means political, economic, social, technological, environmental and legal. This analysis is done for every country, pestle. Okay. Kindly note the basic difference in interest rate. See this, how it goes. If interest rate is, Timothy, not audible. Take this WhatsApp link. Okay. Not audible to somebody. Log out and log in. Okay. Not audible, log out and log in. Kindly note this. So, now understand very important relationship which I am giving you. If the interest rate of any country is up, okay, repo rate. If interest rate or repo rate of any country is up, then the inflation will be down. Kindly note. Inflation will be down. So that is good. Okay. Repo rate is up. CRR is up. So inflation will be down. But GDP will also be down. So that is bad. Bond prices will be down. So that is again bad. Okay. So interest rate has this effect. If interest rate is high, inflation will be down, GDP will be down, bond prices will be down. Okay. Now short-term reasons. Here we saw long-term, now it is short-term. Short-term reason means what? Government controls. Many times what happens? Government takes the control. Where have we seen this? This you have seen it in Afghanistan. When the Taliban came in, it immediately changed the whole scenario. Pakistan, same. Government military is almost taken over. Bangladesh so very gone. Okay. So government regime change or government takes the control of the currency. China is the main part over here. Sure, in China the currency is very opaque. Opaque means what? It's not open to all. Government has fuller control on the yuan. Okay. So government controls. And whereas in our country it's different. In our country it is based on demand and supply. At least in the books. Okay. Capital tends to move from lower yielding to high yielding currencies. Okay. Those currencies which are lower yielding to higher yielding means rate of interest. Low rate of interest to high rate of interest. Capital will always move towards that. That's why we all have this FDI, FPI so much. Okay. Speculative forces. Now these are brokers. Brokers are always there in between. Brokers will always try to do what? They'll always try to give something different. Means do the kite flying. Kite flying means what? This rate is going to grow. Kindly buy this dollar right now. Broker's job is that only. They have a major effect on the short term. Brokers will have a major effect on the short term, but long term they won't have. The term foreign exchange is used to denote a dash as well as the dash of one currency into another. So now this answer me. The term foreign exchange is used to denote dash. What is it dash? What is it? It is used to denote what? Foreign exchange means what? Foreign exchange means other currency, right? Other currency, foreign currency. As well as exchange. It is exchange, okay? Exchange of one currency into another, okay? Manisha, how to join? See this, I am giving you the link. Join this WhatsApp group, okay? I am giving you the link. Everyone join the WhatsApp group, okay? Morning class is same. What is this, Vaibhav? Morning you have two AVM classes. One is crash course 7 a.m. and regular course at 6 a.m. These two are different. Okay? And this is BFM class. This is not AVM class now. Okay? Chala, you move on. So, the exchange rate of major currencies fluctuate every dash seconds. So, this answer is 4 seconds. Okay? The forex markets are dynamic and round the clock markets. True or false? Now you answer this. The forex markets are dynamic and round the clock. Are they round the clock? Answer this, true or false? Correct, Janvi. It is 4 seconds. Now answer this, true or false also. Forex market is dynamic and round the clock. So what is it? It is round the clock. Okay, kindly note. Forex market is round the clock. Okay. Yeah, crash course is at 7 a.m. in the morning. Crash course AVM is at 7 a.m. Okay. Forex markets are not affected by government policies. False. They are affected. So second answer is false. Third answer. Now third one is the same link. No, I don't know. What is the link? That link. WhatsApp link you're talking. Yeah, it is same. Same WhatsApp link. So, large part of Forex is through global commodities. Now third one, everyone. Third answer. Large part of Forex is through global commodities. Commodities means what? Oil, gold. Is it true? Large part of Forex is through global commodities. Is it true or false? Third one, third. It is false. Okay, it's not through commodities. See, your answers are given. So it is false. It's not true. Okay. What are the various payment methods or various transaction days? Most of the transactions in Forex are done on spot basis. Spot. Spot means what? T plus 2. Delivery takes place on the second working day. Second working day. See, there are four methods. One is cash and ready. Cash ready means settlement is done on the same day. Cash ready means settlement is done on the same day. Second is Tom. Tomorrow. Settlement is done on the next working day. Kindly note, next working day. Spot. Settlement is done on the second working day. Kindly note, second means next to next. Kindly don't get confused between next and second. Next working day is Tom. Second working day is next to next. Okay, and forward is any day after spot is known as forward. Any day after spot is known as forward. And last one is future. What is future? Future is known as organized forward. What is organized forward? Organized forward means here. Understand the difference between organized forward and forward. In forward, there are two parties, buyer and seller. Forward, there are two parties, buyer and seller, bank and a customer. Whenever you do a dealing with the customer, normal bank customer, you are doing a forward transaction in Forex. Means future dated. Whenever you are doing a future dated transaction with a customer in your bank, that is called as forward transaction. Only future I am talking of. And whenever you buy dollars through market, stock market, means there is a dollar market. So then it is called a future market. Why? Because there are three parties over there, buyer, seller and exchange. So kindly note, in forward there are two parties, in future there are three parties. Future is known as organized forward. Organized. Okay. The date of delivery of funds means where the settlement takes place is known as a value date. Okay, or settlement date. Kindly note this. Value date or settlement date. Okay. What is the forward rate? Forward rate is equal to spot rate plus premium. Or if it is discount, then minus discount. Okay. Spot rate plus premium or spot rate minus discount. Okay. Now what is premium? Premium means what? Whenever the future rate of the currency is higher than the present rate, it is called as premium. Means, suppose if let's say I am purchasing a flat and this flat's present rate is, let's say, 40 lakhs. After 1 year, the rate is going to be, let's say, 60 lakhs. Then the flat is said to be at premium. Okay. Similarly, reverse. If I am buying the flat at 40 and after 1 year, it is going to be at 30 lakhs. Then the premium flat is said to be at discount. So what does it mean? If the future dated transaction, future value is higher than the present rate is known as spot rate, then it's called as premium. If the future rate is lower than the spot rate, it's called as discount. Okay. Whenever you have premium, you'll have to add. Whenever you have discount, you'll have to subtract. Look at this. Spot rate is given as 80.2333. Look at this. Everyone pay attention. From here, you'll understand how to deal with premium and discount. Spot rate is given as 80.2333. This will be given to you in exam. 2-3 means always left side is buy, bid. 3-3 is always sell, offer. Okay, left side bid, right side offer, sell. Okay. So now this will be given to you 1 month. This is given to you. Look at this. For 1 month, the dollar rate is 10.20. 10.20 means what? 10 is buy, 20 is sell. 10 is buy, 20 is sell. So this currency is called as premium. Why? Because right side is bigger. Kindly note. Right side is bigger. So this is called as premium. Now 2-month currency. Look at it. 2-month. 30.20. So this is called as discount. Why? Because right side is smaller. See this. Left side is 30. Right side is 20. So it is smaller. Discount. 3-month. 40.50. So this is premium. 4-month. 70.60. Again discount. So now what will I do? I'll ask you to find out the 1-month rate. Everyone, give me the buy rate for 1 month. Buy rate for 1 month. Everyone give me buy rate for 1 month. So you'll add this because it is premium. So 80.23 plus 10. So 80.33. Look at this. 23 plus 10. 33. Similarly, sell rate. Sell rate will be 80.33 plus 20. Both you have to add only. Whenever you have a premium, both are to be added. So your answer will be like this. 80 point, see this 23 was there. This forward rate for 1 month is 33. 33 was there. Forward rate for 1 month is 53. Okay, this 53. Got it? So this is known as your premium currency. Now discount 30.20. Suppose if I ask you for 2-month buy rate. So what will you do? You will do the discount. 80.23 minus 30. So it will be 79 point, I think so, 93, this, 83. 93, na? 93103, 103, yeah, 93. Okay. So 79.93. So give me the rate for 2 months now. Buy and sell. Both the rates you give me. Buy and sell. Both the rates you give me for 2 months now. Everyone should give me the rate. Buy and sell both. Buy and sell both I want. Buy and sell both. 2 months. I want only for 2 months. So it is correct. 79.93 and 80.13. 79.93 and 80.13. Okay, just give me 1 minute. Now electricity is gone. Yeah, so it is. What is the answer? 80 point. I want it for 2 months. So 2 months is, you got it? 80 point. Yeah, correct. 13. Sell side. So now you give me the rate for 3 months now. 3 months. Everyone give me the rate for 3 months. Everyone give me the rate for 3 months. And 4. Okay, first give me the rate for 3 months. So 3 months is 80.2333. 40.50. Give me the rate for 3 months. 3 months. Everyone, I want the rate for 3 months. Correct. 6383. Correct. 6383. Okay, now 4 months. 6383 is the right answer. 6383. Okay. Correct. 6383. 63 for buy, 83 for sell. I want it for both. 6383. Always give the rate for both sides. Okay. So 6383. Now, I want the rate for 4 months. 4 months now. See this 80.23. Okay, I want the rate for 4 months. Now you give me for 4 months. Give me the rate for 4 months now. $79.53 and 79.73. Very good. Nalina, Sunita, 536373. 33 minus 60. So 73 it is. 70, not 63. Okay, 73. So what is? So 79.53 and 73. Okay, that is the answer. Got it? Got it, everyone? Vaibhav, you have written 63. Check it, huh? Next. Now you give me this. Everyone. Okay? Now this. Let me see. Spot is this. Buy is this. Sell is this. 1 month. Yeah. You give me this also. Okay. 1 month. In fact, I have already solved it. So forget it. I have already solved this. Okay. So 80.1525, 1030. So it is 80.25 and 55. Okay. And here 4030. So subtract it 79.75 and 25 minus 30, 79.95. So this is already I have solved it. Okay. So buy rate, always remember buy and sell rate. Don't mix these rates. Okay. Forward rates are the function of premium and discount. Okay, kindly note. Now, what do you mean by this? This word dearer comes in exam. Dearer. Dearer means what? Anything which is at premium is dearer. Okay, anything which is at premium will be dearer. Okay, everyone likes the one who is growing, isn't it? Everyone likes the one who is growing. Who is falling, nobody goes for to that person. So dearer means what? Always who is going above is at premium. Okay, dearer. So if GBP is 1.60 and 1 month forward is 1.6050, then what do you mean by this? GBP against USD is 1.60 at spot. Spot means today. And 1 month forward GBP is 1.6050. So it is growing. So GBP is growing. So GBP is dearer. Dearer. Okay. So value of 1 month forward is this 50 basis points dearer. Okay. Similarly, for rupee. Now look at this rupee. Rupee is 48.70 and 69 for spot. And 1 month forward it is 48.02 and 11. So now what is happening? 48.70 at spot and forward rate is 48.02. So it is lesser. So rupees US being quoted dearer in forward is being quoted at this 48.02. So USD is at discount and INR is at premium. So here rupee is premium. Here rupee is premium. Now look at this. You'll get confused now. See, 1.60 GBP was 1.60 and then it grew. it grew to 1.6050. So it grew, it went up, and then it became dearer. And here rupee, it is going down, and then it is becoming dearer. Why? Because the difference is between direct and indirect rate. Direct and indirect rate. What is direct rate? Direct and indirect. In our country, Bharat, we follow direct rate. Direct rate means $1 equals to 80 rupees, 85 rupees, 90 rupees means $1. Dollar is above and rupee is below. See this, USD to INR. So that is called as direct rate system. Indirect means dollar is below, GBP to USD. GBP to USD. So 1 GBP equals to this much USD. So that is known as indirect rate system. Okay. So direct means dollar is constant, rupee is changing. Indirect means GBP is constant and USD is changing. Okay. That is the meaning of indirect rate. In our country, we follow direct rate. Okay. Got it? Now you tell me. See this, spot and forward. GBP is 1.6 in spot and 1.5 in forward. So what is happening? Is GBP weak or strong? See, GBP is going down. So it is weak, discount. Okay? But look at the rupee again, 85 and forward is 84. It is also going down, but it is strong because it is direct rate. GBP is indirect rate. Okay? Understand the difference. Now, how to find out these forward points? These forward points which you write now 20, 30, 30, 40. How will you get this? These forward points have a formula. What is that formula called as? Simple. PNR upon 100. PNR upon 100. P is what? Spot. Spot rate. N is what? Period. Period in days. R is what? Rate of interest. That is same as your simple interest formula. So suppose if I give you 83.40 as a present rate. Period I want it for, let's say, 90 days. And rate of interest is, let's say, 6. Repo rate is 6%. And you are told to find out the forward points. How will you find it out? Suppose if I give you this question right now to you. This is your spot rate. And I want a rate for 90 days forward. Means I want these points, 90 days forward. So 90 days forward points I want. And this repo rate is 6%. Can anyone give me the rate? This forward point. And this is the rate, 40. Let's consider only one, 40. I want it for 40 only. So can anyone give me the rate at this forward point? So 83.40 into I want it for 90 days. So 90 upon 360. In Forex, we take the year for 360 days. So 90 upon 360 into, what is the rate I gave you? 6%. 6 upon 100. So find it. 83.4 into 90 upon 360 into 6 upon 100. Find out, everyone. What are you getting? Let me also try. I have also not tried this. So 80 point, what is this? 83.4. 0.4, no? Yeah. Into 90 upon 360. So 1 upon 4 means 0.25. 0.25. Into what? What is that? 6%, no? 6 upon 100. 6 upon 100. So it is 1.251. 1.251. Okay? 1.251. Got it? This is a forward point. Got it? 1.251. Samir, got this link? WhatsApp link. I have given it in the pin comment, everyone. Okay? So 1.251. Join this WhatsApp group without fail because I'll be sharing important PDF today. Today night I'll be sharing important PDF. Okay, got it? So next. So what is forward point? This is how the forward points are calculated. 1.251. So PNR upon 100. Simple ratio. Okay. Kindly note the link. See what is the link over here. If your repo rate decreases, okay, your repo rate decreases. So as it goes down, your currency becomes stronger. Okay, your currency becomes stronger. Always remember, in the world, the lower your repo rates, the stronger is your currency. Okay? Right now, means I'm talking of right now. Future will be different. Future, after 10 years, the whole game will change. Because many countries are deliberately keeping their these rates down. USA, UK, these are deliberately keeping the repo rate down by printing the dollars. So that's a totally different aspect. We are not going into to discuss that because this is a crash course. In the regular batch, I have discussed this many times. So kindly note, after 5-10 years, things will be totally different than whatever you are seeing right now. It will be totally different. Okay? Move on. The forward premium and the discount rate are generally based on the interest rate differentials. Okay? So basically this repo rate difference. The demand and supply depends upon the following factors. So demand and supply of currency depends on what? Movement of capital. If there is more dollar coming into our country, nowadays what do we have? Look at this. What is the present dollar this? Do you know? What is the dollar reserve today? Dollar reserve for India, for Bharat today. Dollar reserve for India today is what? Okay. It is 677 some billion, I think so. Billion, yeah. 677 billion. It's at the highest level. Highest. So the more dollars you have with you, the stronger you have, the stronger you become. Kindly note. Okay, so the movement of capital in the normal times, as well as in the out of whenever there's a fear sign at that time. Okay, how does the capital move? Capital always moves from low interest rate to high interest rate. Always move. Remember this. Funds will always move from USA to Bharat. Okay, because Bharat gives higher rate of interest and USA gives lower rate of interest. Okay. Status of export and import. Yeah. Status of export and import. Okay. So status of export and import means what? Now look at this. Now see this. These topics are so big to explain. In regular batches, I have explained this many times. But in crash course, it won't. Means I can't give that much time. Export and import. US is a major import economy. Kindly note, US is a major import economy. They are not an export economy. So that's why they are importing. So their currency should have been weaker, but their currency is stronger. Because the reason is different. Here, logically, whichever country does the export should be strong. But that's not happening. Okay? So, status of export and import and trade balance and balance of payment. So, it depends on that. Financial and fiscal status of the country, freedom to invest. Now, suppose if I tell you to invest your money in Pakistan, go and invest. I'm starting a business in Pakistan. Or I'm starting a business in Sri Lanka. Will you invest there? No. Why? Because you know the government status, financial status over there. That's why financial and fiscal status is very important. In our country, you see, we have our rupee is fully convertible in balance of trade. Everyone pay attention. A rupee is fully convertible in balance of trade, partially convertible in balance of payment. Kindly note this. A rupee is fully convertible in balance of trade and partially convertible in balance of payment. Okay? What do you mean by fully convertible? It means that tomorrow if I get an order, or I have to, let's say, yeah, I want to import something. So I have to send the dollars. I want to send some money to, let's say, USA. I want to import. So if I am having a proper bill and KYC is done, then nobody can stop me. Nobody can stop me because I am importing something. I am transferring the dollars from here. I am importing and then transferring. So that is balance of trade, fully convertible. But tomorrow if I say, I want to transfer 20 lakh dollars to my relative in USA. I want to transfer. I am having those dollars, I want to transfer. You can't. Without business, you can't transfer such a large amount. So, under this LRS scheme, you will be having this topic LRS. Under the LRS scheme, you can transfer $250,000 per year, per person. Okay? So, that's why it's called as partially convertible. It's not fully convertible. What is a perfect market? This question also comes in exam. Perfect market means what? In perfect market, there is no government control, no restriction. Government doesn't control your currency in perfect market. Okay? See, there are two ways of controlling. One is control, second is indirect control. If you check Chinese currency today, yuan currency is directly controlled by the government. Their government. Directly means what? Whenever China wants, now you see, now in next 3 to 4 months, max to max 6 months, China is going to devalue their currency. Devalue, lower their currency. Because of this US sanction. If they go on, China will devalue the currency. Now because of this, what happens? If you devalue the currency, okay, so there is a direct control of the government. In our country, we don't devalue the currency directly. Our government doesn't follow this policy of direct control. We follow indirect control. What is indirect? And that is followed by all. Even USA follows indirect control. Indirect is good. Direct is very bad. Okay. So what happens in indirect control? RBI will, suppose if the dollar rate goes up, then what will RBI do? RBI will supply the dollars. It will sell the dollars. If it sells the dollars, then the dollar will be used in supply over here. So when they are used, their rate automatically goes down. So that is known as indirect control. So indirect control is allowed. Okay. So kindly note, government control. And second is import and export is a basic factor. So if you have more exports in the long run, you will always be stronger. Okay. If the rate of interest say in US for 3 months bill is at 2%, while the same rate in London is at 4.5%, there will be a demand for USD in forward market. Now what is this? This you have to understand. Everyone, CAIIB is more about understanding, not about learning, not about rectify. Don't rectify. Okay? If the rate of interest in USA is 2% and the rate of interest in London is 4.5% or 4%, so funds will move from where to where? They'll move from lower rate to higher rate. So they'll move from US to UK. Okay? So they'll move from US to UK. So what will happen? So from US to UK, okay, what will happen? Somebody wants to buy some pounds here. They have to invest in UK. So they'll have to buy the pounds. So in spot market, pound will be in demand because right now I have to invest in UK because the rate of interest in UK is 4%. So right now I have to invest. So I'll buy more pounds, UK currency. So pounds will be in demand in spot. But in future, after 6 months, these, because I am from, let's say, USA, so I have purchased the pounds right now. But after 6 months, I have to go back to my country. So in that case, what happens? I'll have to sell the pounds and buy the dollars again. See here, whenever you go from to any country, their currency is only used. Okay? So in that case, what will happen? I'll have to sell the pounds and buy the dollars. So in future market or in forward market, USD will be in demand, whereas in spot market, pound will be in demand. Okay? See, this is what I have explained. This is known as arbitrage. See, 3 words are very important for your CAIIB. Arbitrage, leverage and hedge. 3 words very important. Suppose USA is having a rate of interest of 2% and UK is having it 4%. Then what will I do as an investor? Now look at it. What will I do? I'll buy a loan. I'll get a loan from USA. Means USA I'll get the loan. What is the loan? Let's say $150 I get the loan. $150 I get the loan. And USA to dollar to pound rate is, let's say, 1.5. Means pound to dollar. Pound is 1.5 times of dollar. So now it is $150 I have taken loan at 2%. So what will I do? I'll go take this money and go to London. In London, now what is the rate? 150 upon 1.5 because pound is 1.5 times higher. So how many pounds do I have? I'm having $150. It means I'm having 100 pounds. So what will I do? I'll invest these 100 pounds in London bank. How much will I gain at the year end? At the end of the year, I'll be gaining 4%. So I'll be gaining 104 pound. So at the end, I'll be having 104 pound. Okay, here I'm having 104 pound at the end. What about this USA? I had taken this loan of $150. So at the end, how much will I have to pay? I'll have to pay 2%. 150 into 2%. So what is 150 into 2%? $3. 3. Right? So at the end, how much will I have to pay? $150. 150 loan and $3 this interest. So net how much I am paying extra? I am paying $3 extra. And here how much I am earning? 4 pounds extra. So when I bring this back to USA, I am from USA, so I'll have to take this money back to USA. So this 104 pounds, when I bring it back, how much will it be? So multiply it by 1.5 because 1.5 times. So 104 into 1.5. So it becomes 156. 156. So now how much have I gained? I've gained $156 in 1 year. How much I am paying over here? 153. So net what is happening? $3 I am earning without doing anything. Did I do something important over here? No work. Just transfer of money from year to year. This is known as arbitrage. Arbitrage means gaining from the growing market. Taking a loan from somebody and gaining it from the growing market. Kindly note this. Okay? So whenever you have to deal with any arbitrage market, always see where the currency is growing or where the ROI is growing, rate of interest. There always money will flow. Now something basic for tomorrow's numerical. Tomorrow we'll be doing the numericals on Forex. Okay? If your currency forward rate, future rate is greater than the spot rate, then the currency is called as premium. You'll have to add. Okay? If your currency is at discount, then you will have to subtract. Forward market has two parties. Market has three parties. Future is organized forward. Okay. Now this example, let me see how much time do we have. We'll take a simple one and then we'll stop. Is this simple one? Let me see. Yeah, this is simple. Let's do this and then we'll stop. The following is the interbank rates quoted in the foreign exchange market. Calculate the rate for inward remittance and outward remittance, assuming margin of 10 paise over the interbank rate. So now you have to calculate the rate for spot rates. Here, there are two types of rates. One is spot, second is forward. Spot means right now. Forward means future. Again, there is one more type of rate that's called as TT and bill. TT rate means spot rate. Always remember. See this. I'll give this over here. See this. Spot rate equals to TT rate. TT, telegraphic transfer rate. Okay. Forward rate. Okay. That is equal to bill rate. Kindly note. Bill rate. Two things always remember. Whenever you are dealing in forward market, you should deal in bill rate. Whenever you are dealing in spot market, you have to deal in TT rate. This is a basic which you have to always remember. So here we are dealing in spot market, value spot. Is it given somewhere that 1 month rate is this much, 1 month, 2 months, something given over here? Not given. So this is spot market we are dealing in. So you'll have to find out TT rate. For TT rate, the things are very simple. See this, inward remittance and outward remittance, both are asked. Inward and outward. Both are asked over here. Inward remittance and outward remittance. Inward means what? Dollar coming in. Now few basics I'll tell you. I might have written it over here. Yeah, see this. Always remember this. These three basics, take the photograph and keep it somewhere where you always study. This photograph is a must for you. In solving any forex problem, you will have to first find out whether it is a buy or sell transaction. Buy or sell. Okay. Whenever there is an inward dollar coming in, inward dollar is coming inside, you will have to buy the dollars. Whenever there is an outward dollar going out, you will have to sell the dollars. So first is buy or sell. You will always have to decide whether it's buy or sell. Second is forward points. If it's premium, you will have to add. If it's discount, subtract. Okay. TT margin. For buying, kindly note, for buying we always subtract. For selling, we always add. For buying, we always subtract. Selling, we always add. Now here there are two problems. One is inward 1 and outward 2. So two problems are asked. So for inward, what will be you be using? Buy. Inward means buy. So 75.0050. Your TT margin will be subtract. Here there is no forward margin. See, always remember, three things are required: buy or sell, forward and TT margin. So there is no forward market over here because it's given, everything is given on spot. So this is 0 over here. Second part is 0. First and third only applicable. So TT margin is minus for buy. TT margin is plus for sell. So now let's write this. For spot rate, what is the buy rate? Spot. What is the buy rate? Left side, 75.0050. Okay, buy. What is the sell rate? 75.0075. See this. Buy is this, sell is this. Now I want it for forward rate. Forward. So forward is given what? Is forward given? Nothing. Not given. So forget it. So forward is gone. Now TT margin I want. What is TT margin given? margin of 10 paise over the interbank rate. 10 paise. So it's directly given in paise, 10 paise. So what you'll have to do, whenever you're doing a buy transaction, you'll have to subtract. So 75.0050 minus 10 paise subtract. So 0.10000. So 0.1 subtract. So 75.0050 by minus 0.10. So you'll get this 50 down and 90 and 74.9050. This is your buy rate. What about the sell rate? 75.0075 plus 0.100 because sell is always plus TT margin for sell. So it will be 75.1075. 1075. So this is what is required. This is what is required. Okay? Correct, Janvi. 75.9050 and 75.1075. This is what is required. Okay? Here your problem ends. This is a simple problem. Tomorrow we will be doing very difficult problems. So don't miss this. Okay? Tell your friends also who are join tomorrow without fail. Because tomorrow's numericals will be very difficult. Tomorrow and day after tomorrow. 2 days we will be carrying on with the numericals. Okay? Chalo, bye for today. Tomorrow morning 6 a.m. is regular ABM and 7 a.m. is your crash course. Chalo, bye everyone. Enjoyed today's lecture. Who all are new over here? Who have joined new? Understood the topic? Understood the topic? Of course, complete theory is not possible today in this class. Okay? Bye everyone.